There we are. Good evening, everybody. My name is Daniel Young. This is Adaptive Perspective. Every week, we separate currents from noise and opportunity from fear using closed end funds and an income focused strategy. It isn't polished, it isn't scripted, and it definitely is not herd thinking. We don't chase headlines, we navigate markets. And I am not a financial advisor, but I am a strategist. I go where the data leads, even when that means walking alone. So, welcome back. The macro data is this: don't let the headlines go to your head. There is a massive gap growing between geopolitical noise and the actual deflationary reality of this economy. One side is a distraction, the other side is a key to where bond prices are headed next. This isn't cloak and dagger stuff. The bond current has been raging below the surface for the past 3 years, and right now it's finally about to break the surface and become a full on raging river. And if you aren't positioned for the shift, you're looking at the wrong map. So this week presents the case of two narratives. There are two very different narratives weaving very different stories, and both are impacting the markets. There's the panic narrative. The same experts who've been wrong about everything are telling you they're still right on the next thing. The war with Iran will last for months. U.S. oil prices are tied directly to global supply. The Strait of Hormuz disrupts U.S. shipping. AI is ending jobs and careers. Oil prices are out of control. The economy is slipping back into inflation. And somehow, all of this adds up to the end of America as we know it. And it just doesn't make sense to me. So I present a rational narrative. The same experts who've been wrong every single time on every single issue are still wrong. The Iran situation is a short term deal. The US energy supply is independent. US shipping isn't tied directly to the region. Oil volatility is being driven by fear and a lack of understanding, not a domestic supply issue. And AI is forcing efficiency, not eliminating work entirely. We are not in a sustained inflationary period. AI is deflationary. Iran is temporary. The larger issues remain the private credit market and its rippling effects and securing the vote. But I'm not here to discuss how to secure the vote. I want to focus on the markets because the market doesn't move based on the loudest story. It moves based on what actually changes underneath it. Now, regardless of narrative, the real question is this: are the financial currents changing, or are we just hearing more noise? Right now, the currents are not changing. It's noise, just louder than usual. There's a lot happening at once, and that confusion is exposing many expert analyses. And to be transparent, that's not a bad thing. We want the non experts exposed. Every single expert who says they're an expert and has been wrong every single time is not an expert. We want those people exposed. But the confusion creates opportunities for people who can think clearly. So just remember, noise increases emotion and currents determine direction. So our positioning hasn't changed. We are still operating with the same targets: bonds and their proxies, end to end energy, technology infrastructure, AI as well, and real estate. Now, bonds are at the top because AI is deflationary, and deflationary pressure leads to lower rates over time. And when rates fall, bond prices rise. As it pertains to bond proxies, not all proxies are equal. And at this point, they're not my focus on primary acquisitions, but they remain reasonable if I already own them. BDCs is where the market gets nuanced. The standard thinking says lower rates reduce BDC income. Credit stress increases risk. And in that environment, BDCs are a sell. The logic makes sense. but the market doesn't always operate on clean logic. To fund AI, infrastructure, and capital expansion, the system still needs lenders. That's why it's difficult to completely dismiss BDCs. So think of it like this. I still hold FSCO. It operates like a hybrid between a bond fund and a lender to mid-sized businesses or like a BDC. Instead of buying debt from massive corporations, it lends directly to smaller companies at higher rates. That's why it produces a double-digit yield. But that comes with trade-offs: less liquidity, higher credit risk, greater sensitivity to rate changes. Because most of its loans are floating rate, when interest rates fall, the income it generates falls with it. So it's not a safe bond, it's a credit engine. Higher rates rev the engine. Lower rates don't pump the brake, but it's not a consistent pedal to the metal either. Since I already own FSCO, it's a hold. The combination of private credit concerns, dividend pressure, geopolitical noise created volatility. But that doesn't automatically mean failure. The real question is whether it stabilizes. If the price and discount don't improve, so if the price and discount don't improve within the next 3 to 4 weeks, say end of May, then it becomes a position worth moving on from. If it does improve, great, but it's still a rotational candidate to stronger bond-based positions. So in the very near future, there are two near-term paths. We have a resolution of the conflict in Iran. I think the markets would move higher and quicker, or quicker higher. There's also the possibility that the conflict escalates, which would mean the markets dip again. Both are possible. And that's why perfectly timing the market isn't the goal. Preparation is. You don't have to predict the outcome. You just need to be ready for the outcome. So I believe when the Iran situation resolves, sooner than later, oil stabilizes, markets return to risk on behavior or think game on behavior, and rate cuts remain likely. But that doesn't mean I control the outcome. It means I position around the probability. So I talk about what I'm doing in my portfolio. I try to explain my rationale in these videos. So, and I'm transparent. So when I tell you this, I'm not fluffing your feathers at all. I won't be investing at tomorrow's opening bell. I'm going to watch and see how things unfold. Iran's decision deadline is 30 minutes after the opening bell. It's not like I'm going to be Johnny on the spot and invest right when the market opens. Iran has a choice to make, and that choice determines their course and cues my decisions. I also think it's going to impact the market. So if they surrender, I think markets would rise. If they drag it out, I think markets dip or stutter. Whatever they decide, we play our cards as they're laid or as they're dealt, however you want to say that. It's just a waiting game. Cause and effect felt globally and locally. Now, you and I can both go back and forth on what we think they'll do, or maybe what they might do based on past interactions. Doesn't matter until the decision is announced or made. So my dishwasher's done if you heard the little tinkling. So with that financial backdrop in place and the table set, let's move into the closed-end fund snapshot for this week. These are my top funds for the opening bell and why they made the list. So let me get to my spreadsheet and then share my screen. And here we go. So not all of these funds will make the final cut. I kept these as the top initial funds. I screened a lot out. There's a lot in dollar cost average territory right now. There's tons of triple asterisks. I mean, gosh, to review the whole system, not my point, but if you're new, If you are new, I create a target system based on historical discounts for funds. And then I sort the list into so we'll say like a pre-list. Every fund that has a triple asterisk ends up on one of these tabs. And then I sort the tab based on currents, and I trim it down from there. So if everything has a historical discount at triple asterisk, this one is a dollar cost average for me, so it's still here. But if everything is on the list with a triple asterisk, we then sort by dividend policy and then by overall yield, with the goal to prioritize 9% or greater yields with some exceptions. So intro over. So here's the pre-final list with 7 funds. We're going to tone it down to 4. But here's what else is still on the list. HFRO, I've increased its contact card. There we go. So you can pause the screen and read, and I will not read all of this to you. HFRO is on the list because it boasts one of the greatest discounts at 50% off discount. It's like buying the fund for 50 cents for every. It's like buying the fund for 50 cents for every dollar invested. IGR remains on the list. Well, okay, so HFRO, it's a triple asterisk, crazy discount, monthly payer, yield below 9, but it also has an insane discount. But it's also still on the list because it's one of those flowing currents. It's a bond proxy in real estate. IGR is also a real estate current, or also a real estate tag and a bond proxy. It makes the list for that reason and for this example. It pays an incredible yield. But if we're prioritizing discounts, it's premium. So it would, instead of getting HFRO for 50 cents off, this is like paying $1.01 or $1.02 for every dollar invested for IGR. It's an insane dollar cost average move for me. It still pays a hefty yield, and it's a bond proxy. But right now, it's really hard to look past bonds as its own entity. So DOY is a bond fund, but it also has a higher CLO count than others. And that CLO market is sketchy right now. The CLO market and that private credit market, people are pushing for transparency, and it's really hard to get transparency in that market space. So DOY is a great fund. It's honestly on my hit list of funds that I would love to pick up. But with that private credit volatility, it's just not going to make my final cut today. So I can get rid of these 2 funds. I can get rid of this fund. And all of these funds are, like, for me, all of these funds are great pickup. But I'm trying to both prioritize bonds and not so much bond proxies. I'm also trying to prioritize how the bond funds are coordinated. Like DOY boast about and boast a higher CLO footprint than others. DSL supposedly has a small CLO footprint. PIMCO, I haven't found anything about any of their funds having, these 3 funds having any type of CLO footprint. So DSL remains on the list because it fits all the parameters, especially because I already own it. PDO, I own it in both portfolios, the cash brokerage and the Roth. This is what I currently have pending Monday's outcomes. We'll get to that next week. But if you asked me to invest, if you asked me if I was going to invest Monday, I would say maybe. Definitely not at opening bell. What would I buy based on the list? I like to buy things based on. I like to buy things based in 50s and 100, or like sets of 50 and sets of 100. So on the list, that's the only fund I could pick up. So I would pick up 200 shares in the cash brokerage. As for the Roth, uh, gosh, PDO is extremely tempting. The Roth I want for longevity. And I just found out, of all things, I just found out today that PDO is supposedly a term fund when I haven't seen anything about that before. So I already own it, so it would be tempting to buy it. But also PTY, it's really just like Brett Owen says, it's really hard to argue with PTY's performance. So it would be a tempting buy as well. That being said, I'm not going to buy first bell or like right at the opening bell. Um, my plan or my game plan is to see how that drama plays out and not knee jerk reaction. Like the decisions and the options are there, the decisions are already made. It really just depends on which way they go, and we'll see how that turns out. But as it pertains to my list for the week, it's this list. And if you've watched my videos before, I've you can pause the video. I'll wait 3 seconds, I guess, between each. That way you can go back and read. Um, put more reference material on each fund. None of us have all the money in the world, so it's prioritizing your buys. It's it, on my end of things. I prefer to buy what I already have. I prefer to get a great deal. I mean, almost everything's a great dollar cost average ad right now. But if I'm going to pick up something new, it's got to be better, or it's got to be better than what I already have. Uh, and PHK may or may not be better than what I already have, but it's certainly different than what I already have, and it's on discount. On the PIMCO funds, they rarely hit discount territory, rarely hit true below zero discount territory. So instead of looking at that metric, we're looking at their discount compared to their 1 year rolling average. PTY's got the best discount for the 1 year average, and PTY and DSL have the best gap, maybe the widest gap between current price and general. I don't want to say normal pricing, but I guess we could say normal pricing. So on my end of things, I would prioritize what I already own or buy something I don't already have. And quite honestly, PHK, PTY, DLY, those funds. The other bond fund that's on my wish list is AWF, but it didn't make this list. No, AWF. Uh, but they just sit on my wish list of we'll just say anchor funds that would hang out in a fund regardless of the market. I mean, it would take a pretty significant shift to shift out of bonds, and we've seen it happen. Uh, it would take a pretty significant shift to really shift out of bonds, but I would love to create an anchor base to my portfolios that just it's a collection of bond funds that just sits there regardless. So between PHK, DSL, PTY, PDO, PDI, which is generally beyond my price comfort, AWF, DLY, those are my wish list of funds. And it just happens to be that several of those funds are currently on the target list and present great opportunities for the current situation or the current market. So this is my list for the week. All right. So as I close this video, most investors try to predict what happens next. Like they're always trying to predict the market. But the better question is, where is capital already flowing and how do I align with it? And right now the answer isn't exciting. It's consistent, and regardless of market, regardless of the chaos and the waves and everything going on, the market will eventually follow the data, even when the headlines don't. And that's why bonds continue to sit at the top of our list. So that's all I have for the week. I wish you a wonderful week, a successful week. Like whatever you have to do, I hope you get through your to-do list for the week. And I will see you next Sunday. So have a great week, everybody. And I wish you well. Bye bye.